Hello and welcome to Chapter 13. This is Professor Farhat. In this session we're going to look at learning objective number 5 and explain how equity is reported for a corporation. Once again, this is Chapter 13 in your textbook, and we're going to look at how equity is reported within your corporation. The first thing we need to remember is this. The stockholder equity section, what are the two main components of the stockholders equity section? The two main components are common stock and retained earnings. So those are the two big components. Common stock, sometimes we would have preferred stock, but common stocks, what does common stock represent? Represent contribution made by owners. So common stock represent contribution made by owners, and another account within common stock is sometimes what we have is paid in capital. So common stock and paid in capital, both of them, they represent contribution made by owners. Retained earnings, on the other hand, as the word suggests, retained earnings, it's the cumulative profit and loss over the years. The cumulative profit and loss. So when the company makes a profit, they park the profit, they put the profit into retained earnings. So if in year one, let's assume they made a profit, let's assume year one they made a profit of 250,000. Year two, they had a loss of negative 110,000. Now, if you want to know the retained earning is 140,000. Let's assume in year two, the company happens to pay dividend of 25,000. Dividend reduces retained earnings. So this is dividend, and this is net loss, and this is net income. Okay, so now then, how much is retained earnings? Retained earning is reduced by the dividend, 115. So let's assume in year three, the company makes a profit, which is net income. This is year three of 65,000. So this is net income. So what's going to happen to retained earning? We're going to take the 115 and add 65,000. Now let's assume in year three the company pays dividend of 15,000. This is dividend. So what will be retained earning? Well, dividend reduces retained earning. So the reason I'm doing this is to show you that the main accounts that affect retained earnings, and those are net income, which is affected positively. It increases retained earning. So the company starts with zero retained earning. Then net loss reduces retained earning. Dividend reduces retained earning. So those are the three accounts that mainly affect retained earning. It doesn't mean that we don't have any other accounts, but those are the only three transactions that affects retained earning. And if you listen to my prior recording, you notice that sometime when we sell treasury stock and we incur a loss, we also book the loss within retained earnings. But those are the three main components of retained earnings. So in the book it says, you learn that the two basic sources of the equity is paid in capital, which is common stock and paid in capital account, and retained earning. Okay, so now what we're going to do, we're going to dig a little bit more within retained earning. So before we get to retained earning, the company prepare a statement called the statement of retained earning. So you could prepare a statement of retained earnings. So you want to keep track of your retained earning. And let's assume your prior year retained earning, which is the beginning retained earning from the prior year, was 5 million. So this was 5 million. Then you made a profit of 1,050,000. So notice we took the 5 million plus 1,050,000 gave us 6,050,000. So here, if you want to look at here, year zero, here we are talking year zero, your beginning retained earning was 0. So this was your beginning retained earning here was 0. Okay, but here we said we have a prior retained earning from the prior years. Then the company declared a dividend of $500,000. So how do dividend affect retained earning? Dividend reduce retained earning. So we would reduce retained earning by $500,000. So your ending retained earning, which is December 31st, 2016, is $5,550,000. Sometimes a company, if over the years they have more losses and dividend than net income, then the company would have what's called a deficit in retained earning. A deficit balance in retained earning is when retained earning is negative. So simply put, let's assume this company up here that we're looking at right now declared a dividend of $7 million. Let's assume they declared a dividend of $7 million. Okay? Well, what's going to happen? The dividend will eat up all the retained earning. Well, declaring dividend is not a good example because often you have to have retained earning, but let's assume they incurred the loss of $6 million. So they had $5 million from the prior year, then this year they made a loss of $6 million. Then their retained earning will be negative. Okay? So if retained earning is negative, we call that a deficit retained earning. It occurs when a company reoccurring losses and or declares dividend in excess of retained earning. That could happen. Another term that we need to be familiar with when it comes to retained earning, appropriation of retained earning. What is appropriation of retained earning? So when and how do we appropriate retained earning? Basically, appropriation means restricted. So let's assume a bank may agree to loan $500,000 to Smart Touch. So let's assume a bank agrees to lend the company $500,000 only if Smart Touch Learning maintain a minimum level of stockholders' equity by limiting both its declaration of dividend and its purchase of treasury stock. So the bank, they want to protect themselves. So how do the bank protect themselves? They will put restriction on the company. For example, they would say your retained earning or your equity cannot be reduced below a certain amount. For example, this example here, for example, they would say you cannot have a retained earning below $5 million. So your retained earning has to have a minimum of $5 million. Okay, so here you're in good shape because you have $5,550,000. So that's why they want to protect themselves. And if that happened, for example, they would say we will increase your interest rate or we can charge you higher interest rate. Okay, so this is what's called appropriated retained earning. And if a company has appropriated retained earning, they have to disclose this information. So restriction of a portion of retained earning that's recorded by a journal entry. So they have to let the users know that part of the retained earning is restricted. There is nothing that they can do with it. Okay? A corporation may appropriate, that is segregate in a separate account, a portion of retained earning for a specific use. For example, the board of directors may appropriate part of retained earning for expansion or contingency, such as a potential liability associated with a lawsuit. Also, the company internally, you don't have to have the bank imposing this on you. For example, the company can declare that they would like to appropriate, restrict certain amount of retained earning for future expansion. That's also a form of appropriation. It's either external or internal. Prior period adjustment. What is a prior period adjustment? Let's assume an error, we had an error happened in the past. Okay? And for illustration, let's assume that Greg Toons recorded $30,000 of salary expenses in 2014. So this is how much they recorded. The correct amount of salaries expenses was $40,000. So what did they do? They understated their salaries expenses by $10,000. Because they understated their expenses by $10,000, their net income was overstated by $10,000. Now when did this happen? This happened in 2014. And we are in 2015. So what happened is this. Once we get to the second year, all expenses are closed. So we cannot go back and change the expenses because the expense accounts are closed. So what do we need to do? We need to adjust the beginning retained earnings. So what we need to do, we need to adjust the beginning retained earning. So what we do is this. When we prepare our retained earnings statement for Greg Toons, so you have Greg Toons, the name of the statement, year ended December 31st. Then the beginning retained earning as originally reported was $140,000. So this number is given to us. The $140,000, it's given to us. Okay. Then what you do, since you had an error in the prior year, and that error was to understate expenses, which in turn overstated net income. So what happened the prior year, your retained earnings should have been $130,000, because if in the prior year you appropriately recorded 40,000 of expenses, your net income would have been lower by 10,000. Okay, so now what you do is you correct your beginning retained earning. So your retained earning, this is the 140 is not the correct retained earning. So this number is not correct. The 140 is not correct. So what do? We reduce it by 10,000, and this is retained earning January 1st as adjusted or as the correct amount. So the correct retained earning is 130,000. So now we did fix the error from the prior year. How did we fix it? We reduced our retained earning. Sometimes you have to increase your retained earning depending on the error. In this situation, the error understated expenses. We underreported expenses. Well, if we underreported expenses in the prior year, it means our retained earning was higher because our net income was higher. So to fix the error, we have to reduce our retained earning by the same amount of the error. Okay. Then this year net income was 63,000, so we're up to 193. Then the company declared a dividend of 23,000. Dividend reduces retained earnings. So the ending retained earning is 170,000. So next year, January 1st, 2016, our beginning retained earning will be 170,000, assuming we did not make any errors. Okay. Okay. And sometime what companies do, they report the statements. They will have their own statements of owner's equity, in more detail statements of owner's equity. And let me show it in the on the PowerPoint slides. It's because I want to show you again what we learned about the statements of stockholders' equity. Once again, just to remind you, this is a stockholders' equity statement. We have the beginning balances and we have the ending balances. And when we talk about stockholders' equity, what are the two main components of the stockholders' equity? Well, it's contribution by owners, which is common stock and paid-in capital. This is what the investors, this amount here is what represent what the investors contributed. Investors. Sorry, I'm writing with the mouse. It's quite difficult to write with the mouse. So this is what the investor contributed, and the other big part of retained of stockholders' equity is retained earning. Okay, so the balances as of January 1st, we had 20,000 shares outstanding. The amount was 20,000, so the par value was $1, and we had 80,000 in paid-in capital. What happened during the year? Nothing really happened. So nothing really happened. Notice if we go down across, we still have 20,000. We did not issue any new shares. If we did not issue any new shares, we still have 20,000 in common stock and 80,000 in paid-in capital. Now retained earning. Our beginning retained earning was 40,000. Again, this number is given. So the beginning retained earning was 40,140. We had a prior year adjustment, which is reduced the retained earning to 130. Then we had net income, which is a plus. Then we had dividend, which is a minus, and this is the ending retained earning. And this is the beginning balance, 240, and these are all the changes, and the ending equity is 270,000. So our equity went up by 30,000 from the prior year. Why did it go up? Because we made more profit than when we paid in dividend. So our equity went up. So this is called statements of stockholders' equity, and you will learn about this statement a little bit more in intermediate accounting. But what I want you to see, the two main components of the stockholders' equity are the investors and the retained earning. What the investors put in, and retained earnings, what the company generated in profit. Now there are other sections. Remember, we had treasury stock, okay? And there's other sections in equity, but those are the two main components that you need to be familiar with. So let's try this example. We have this company had beginning retained earning of 30,000. So this is beginning retained earning. During the year, they declared and paid dividend of 140. So they dividend, and this is basically dividend is a negative, so I'm going to put this in parentheses, and earned 200,000. And how do earnings affect retained earning? It's a plus. So we're going to start with 300,000, add 200,000, then subtract 140. So we're going to take, this is the beginning, given to us 300,000. We're going to add net income, which is 200,000. Add net income, then we subtract the dividend, and ending retained earning is 360. And this is how we prepare a statement of retained earnings. If you have any questions, please email me.